Welcome to the CLS Market Review for the week of September 23, 2013. I'm Scott Kuby. Last week, the Federal Reserve surprised investors by making no changes to its $85 billion a month bond buying program. Investors had expected the Federal Reserve to reduce or taper its purchases in September. The lack of a change constituted a surprise to markets. As this graphic from the Wall Street Journal shows, economists who thought tapering would begin outnumbered those who didn't by 2 to 1. In some ways, investor expectations were self-defeating, because higher rates became a concern of the Federal Reserve. As more investors anticipated a reduction in the bond buying program, rates rose. On Wednesday, Federal Reserve Chairman Ben Bernanke also cited higher rates as a threat to the recovery and a reason for delaying reductions in the bond buying program. Reactions to the surprise move were very positive in the market, but often negative by investment managers commenting on the decision. Albert Edwards from Societe Generale said, "Personally, I'm incredulous. I can believe the Archdub Bernanke might have wanted to keep blowing his bubbles, but I am amazed that he got the rest of the Fed, or at least the majority, on his side." Later, he compared Bernanke to Rudolf von Havenstein, who was the head of the Reichsbank during the German hyperinflation after World War I. Lately, investors have been concerned about any bond exposure. Requests for cash instead of bonds are on the rise. Before making a request to exit bonds, investors should pause. As has been mentioned in our weekly write-ups previously, bonds can still outperform cash if rates rise slowly. CLS portfolios continue to have lower than normal exposure to interest rates. We are not reducing this exposure to zero. While we are focused on the risks of bonds, we also recognize the extremely low returns for holding merely cash. As long as the market offers meaningful yield improvement for modest interest rate risk, CLS will chart a balanced approach to fixed income allocations for its clients. Thanks for watching. We'll see you next week.